Welcome back to The Deep Dive. Today, we're digging into Amphastar Pharmaceuticals, ticker AMPH.
Yep.
And their latest earnings report for Q3 really, it caused some confusion.
It really did. We're looking at the call from November 6th, and, on the surface, the numbers look messy.
Right.
But the story here is a major strategic pivot, and our job is to sort of filter out that noise.
Be the detectives, figure out what's really driving the business underneath all those one-time costs.
Exactly, because this quarter was, I think, a necessary expensive step for them. The market saw the cost first, and we're going to explain why the smart money looked right past it.
Okay, so let's start with that initial noise. It was a classic mixed signal, wasn't it?
A total mixed bag.
You had the adjusted EPS come in at 93 cents. The street was looking for what? 83 cents? That's a nice beat.
Very solid beat, about 12-13%.
Error.
And revenue was the same story. They hit $191.8 million when consensus was around $184.5.
So two clear beats. But here's the wrinkle. Total revenue was basically flat year over year.
And that flatness is important. It shows you the headwinds in their old business are very real. But the panic, the reason the stock dropped 4.3% right after the release.
Came from the official GAAP numbers.
Exactly. The diluted GAAP EPS fell off a cliff. It went from 78 cents a year ago down to just 37 cents.
Wow.
So the market saw that, saw the compressed profits, and just hit the sell button without really asking why.
So if GAAP earnings collapse, but their adjusted numbers beat, that tells you the core business is actually pretty healthy. It's just that the accounting department had a very, very expensive quarter.
Precisely. And the real momentum is hiding just underneath that. It's all in their proprietary portfolio.
Absolutely. The two big proprietary anchors are the real story here. Let's start with BAQSIMI.
BAQSIMI is their ready-to-use nasal glucagon, and it's just booming. It pulled in $53.6 million in revenue.
Which is, what, a 33% jump year over year?
About 33%, yeah.
Yeah.
So think about that. In a quarter where total revenue is flat, this one product is accelerating like crazy. It now makes up 28% of their entire revenue base.
That's a huge shift in the mix. And it's not just the BAQSIMI, their consumer product, Primatene Mist, did well too.
It did, $28.8 million, also strong double-digit growth. So the proprietary side is really holding the company up right now.
And they seem to be dominating their target market.
They are. Management was pretty clear on the call. They estimate their share of the ready-to-use glucagon market is sitting somewhere between 55 and 60%. They own that segment.
Okay, so that begs the question. If BAQSIMI is up 33% and total revenue is flat, something else has to be falling pretty hard. Where's the erosion?
It's in the generics, exactly where you'd expect. Their old glucagon injection kit. Sales for that declined 49%.
49%?
Down to $13.6 million.
But here's the thing, that's not just competition. A lot of that is internal cannibalization.
So patients are just moving from the old clunky kit to the new easy-to-use nasal spray.
Exactly. So that decline, even though it hurts that one product line, is actually a positive sign that their strategy is working. Makes sense. They're trading low-margin generic sales for high-margin proprietary sales. What about their other legacy products?
Also took a hit. Epinephrine and lidocaine sales were down. That was partly competition, but also because some of the supply shortages in the market have eased up, so other suppliers are back. It just reinforces why they have to make this pivot.
Okay, let's get to the root of that GAAP earnings collapse. Operating margin went from almost 30% down to 13%. That's drastic. Where did that come from?
It wasn't from selling stuff. Gross margin only dropped a little bit, down to 51.4%. The real damage was in the operating expenses. Two huge one-time drivers.
Right. What's number one?
A massive $23.1 million litigation provision. It's related to a civil jury verdict. So it's a one-time accounting charge to cover a potential payout.
$23 million is huge. That alone explains a massive chunk of the difference right there.
It really does. The second big cost was more of a strategic investment. It was a $5.3 million upfront payment for R&D on that new Anji licensing deal.
So you pull out those two things, the legal charge and the R&D payment, and the adjusted earnings suddenly look pretty strong.
They look remarkably strong. It was, like management said, an investment quarter, just one with very messy optics.
And they're already getting a return on some of these investments. They launched a new product.
Absolutely. Their iron sucrose injection, AMP-002, got FDA approval in August, and they launched it right away.
And it generated sales already.
Pulled in $2.4 million in Q3, and that was only for half a quarter. It shows the engine is still working, they can still get products approved and on the market to replace that fading generic revenue.
Which all ties back to that core goal. Shifting to a specialty platform, what's their target for that revenue mix?
Their medium-term goal is pretty ambitious. They want proprietary products to make up about 50% of total revenue.
They're at 28% now, so they've got a ways to go.
They do. And this Anji licensing deal is the biggest, most forward-looking move they've made to get there.
Tell us more about that. It seems to take them into totally new territory.
It's a huge step. It's an exclusive deal for 3 novel candidates in oncology and ophthalmology from a company called Anji Biotechnology.
So cancer and eye disease.
Right. And it's a big deal.
Oh.
Up to $453 million in milestones plus royalties. This isn't some small add-on. It's a major expansion of their R&D focus.
And there was one asset in that deal, AMP-107, that got a lot of buzz on the call. What's the story there?
The potential is just massive. AMP-107 is a non-invasive eye drop for wet, age-related macular degeneration.
An eye drop.
An eye drop. Right now, the treatments for that are all painful injections directly into the eye. It's a $9.4 billion market built on injections.
So if this works, it could be the first non-injectable treatment.
It could completely reshape the market. The convenience for patients would be incredible.
That's the huge long-term prize. But let's bring it back to the near term. What should investors be watching for over the next 6 to 12 months? What's the guidance?
Well, the guidance for 2025 is still flat revenue. They're absorbing those competitive hits this year. But for 2026, they're guiding for high single-digit to low double-digit revenue growth.
So they expect the investments to start paying off pretty quickly.
They do. And the immediate test of that is coming up really soon.
What's that?
It's a regulatory decision. Everyone is focused on the FDA action date for teriparatide, their AMP-015 product. That's coming in Q4 this year, 2025.
And a launch could be in early 2026?
First half of 2026, potentially. And this is a complex generic. A successful launch here would be a huge validation of their R&D and manufacturing capabilities.
And there was another big generic launch they talked about for next year.
Absolutely. The AMP-007 inhalation product. That one's on track for a mid-2026 launch.
And the market for that is big.
It's a $1.5 billion addressable market, and they think they have a shot at being the first generic to market. That kind of first mover advantage is exactly what they need to hit that double-digit growth target in 26.
Interesting what they're not including in that 2026 guidance, though.
Right. They're being explicitly conservative. The big ones, the GLP-1 generic and their insulin aspart biosimilar, they're guiding both of those for 2027 launches.
So nothing from those is baked into the 2026 growth story.
Nothing. They even said the GLP-1 space is getting crowded, which suggests they're not going to rush in. They're setting very realistic expectations.
Which brings us back to the market reaction. Why did the stock rebound so hard, up 12% after that initial 4% drop?
Because the street ultimately bought the story. The analysts looked past the messy optics and saw the core momentum. In fact, most of the coverage pointed out that Amphastar had the strongest combo of revenue and adjusted EPS beat among all its peers.
So the market just decided that the initial dip was an overreaction to some one-time costs.
It did, and you could see it coming if you're looking at the options market.
How so?
The put-call ratio was around 0.20. That is an incredibly bullish skew.
Yeah.
It means for every one person betting the stock would go down, 5 people were betting it would go up.
So the derivatives traders were already positioned for the good news to win out.
Smart money was betting that the underlying story was stronger than the GAAP noise.
And what about the balance sheet? Do they have the cash to fund all this R&D and the Anji deal?
They're very well capitalized. They actually spent $55 million on share buybacks this year, which shows you what management thinks of their own stock price.
That's a strong signal of confidence.
It is. And they still have over $216 million in cash. And that cash is crucial, not just for R&D, but for a big expansion of their U.S. manufacturing. They want to control their own supply chain.
Which is a massive competitive advantage these days.
A huge advantage, especially for complex products like biosimilars. It's an investment in future cost control.
Okay, that brings us to our favorite segment, explicitly for entertainment purposes. This is not financial advice. What's the outrageous but plausible trade here?
Well, the whole setup is that the market is undervaluing their ability to execute, specifically on the regulatory front.
So the bet has to be tied to that.
The trade is to go long AMPH, but specifically by buying call options that expire right after that Q4 2025 GDUFA date for teriparatide.
Ah, so you're betting on the catalyst.
Exactly. The thesis is that a clean, successful approval on that complex generic will be the signal the market needs. It'll prove their R&D engine is undervalued and could trigger a really quick repricing of the stock back up towards those analyst targets in the low to mid-30s.
A very specific bet on their execution with the FDA. So to recap for you, our listener, Amphastar's Q3 was a pivotal, messy, and expensive investment quarter.
Right.
They navigated serious pressure on their old generics by pouring fuel on their proprietary products, like BAQSIMI, setting themselves up for a return to growth in 2026.
And here's a final provocative thought for you. Management seems convinced that generic competition for Primatene Mist is really unlikely even after the patent expires in 2026.
Why is that?
They argue the margins are just too thin for a competitor to make it worthwhile. So the question is, in a world where commodity generics are getting crushed by pricing pressure, how much value should the market put on these durable, proprietary OTC cash flows that seem shielded from that competition? That durability might be the real story that drives the stock higher long term.